Hey everyone, and welcome back to the Deep Dive. Today we're taking a plunge into a topic that, well, it touches nearly everyone's life, whether they realize it or not. Taxes. But this isn't just about the usual annual filings. Nope, we're talking about a landmark shift in India's entire tax landscape. You see, for over 60 years, India has relied on the Income Tax Act of 1961. It's been the bedrock, the foundation. But let's face it, the world, it's changed dramatically since 1961, hasn't it?
Oh, absolutely.
Economies are more digital, more global, way more complex, and that's why, back in July 2024, the Indian government announced they were doing a comprehensive review of this, well, this really long-standing act.
Indeed. And that brings us to our mission today. We're here to unpack the newly proposed Income Tax Bill 2025. And let's be clear, this isn't just a minor tweak. It's not just a few amendments here and there. The aim is to entirely repeal, get rid of, and replace the whole 1961 Act. The stated goal, and this is important, is to make the Tax Act concise, lucid, easy to read and understand. That's a pretty significant undertaking, really, trying to strip away decades of accumulated complexity. So we'll be navigating through its key provisions, the new definitions, the major changes it introduces. We want to help you grasp what this monumental shift could truly mean for, well, for your financial life.
Exactly. We'll cut through the jargon, promise. We'll highlight the surprising facts, the implications, and we'll get right to the core insights of this new bill. From how your income might be defined differently to, frankly, groundbreaking new ways of taxing digital assets, and even how things like penalties are changing. We'll cover it all. So let's unpack this, shall we? Rewriting the foundation. Why a new bill and core definitions? Okay, first off, this is a massive undertaking, right? We're rewriting an entire foundational legal document. When you're replacing something that's been around for over 60 years, the motivation must be pretty substantial. So what really truly drove this grand overhaul?
Absolutely, it's huge. And the primary driver, as it's explicitly stated in the source material, is really that phrase, concise, lucid, easy to read and understand. Just think about it for a second. The 1961 Act, over decades, it became this labyrinth, full of amendments, notifications, court interpretations piled on top of each other. It was sprawling, often ambiguous, and honestly, incredibly challenging. Not just for the average taxpayer, but even for experienced professionals sometimes.
Right, leading to confusion, disputes.
Exactly. Prolonged litigation, compliance, headaches. So this new bill is a very concerted effort to simplify all that complexity. The aim is greater accessibility, less ambiguity, which is just paramount for a modern economy, isn't it?
So for the everyday person listening, this isn't just about new numbers on a tax form then.
Not at all.
It's potentially a whole new way of interacting with the tax system itself, one that aims for clarity over confusion. We often talk about information overload in our lives. This bill sounds like it's trying to be a shortcut to clarity in the, let's be honest, often daunting world of taxes.
That's a good way to put it.
I imagine a tax system that's actually, understandable without needing a law degree. That seems to be the aspiration here.
And to get that clarity, the bill logically starts by revisiting and updating the fundamental definitions. These are the building blocks, the absolute foundation of the entire tax framework. And getting them right for the modern era, for today's economy, is absolutely crucial.
Okay, let's dive into some of those. Starting with a term we all think we know, tax year. How is it precisely defined in this new bill? Is it any different from how we understand it now?
Well, the bill clearly defines tax year pretty much as you'd expect. It's the standard 12-month period of the financial year starting on April 1st. So that aligns with what most people are familiar with.
Okay, standard financial year.
Exactly. But it does add a clarification. For new businesses, or maybe a new source of income you start earning mid-year, it clarifies that the tax year for that specific source begins from the setup date. This just ensures a universal understanding, a clear, unambiguous starting point for absolutely everyone. From big corporations to, a new freelancer starting out, it basically formalizes what we already think of as a financial year, just removing any tiny bit of potential misinterpretation.
Right. And we often hear terms like assessee and assessing officer thrown around, especially when, dealing with the tax department. But for those of us maybe not deep in tax law, what do these terms really mean? How does the bill clarify them? Who are we actually dealing with?
Good question. The assessee is defined quite broadly. It's basically any person by whom tax or any other sum of money is payable under the Act. But it's not just the person paying tax. It also includes anyone who's involved in any proceeding under the Act, like an inquiry or an assessment being done on them.
Okay, so is anyone liable or under scrutiny?
Precisely. And the assessing officer, on the other hand, that's the specific income tax authority. Could be an assistant commissioner, an income tax officer, whoever has been legally given jurisdiction over a particular assessee. This clarity is really important because it spells out exactly who is liable for tax and which specific authority they'll be interacting with. It brings more transparency to the whole administrative process.
Now, here's where it gets, I think, really interesting for a growing number of people, especially in our globally connected world. The shifting sands of non-resident income. This is highlighted in Clause 11, right? This could have pretty big implications for expats, digital nomads, maybe even companies hiring remote workers across borders.
It absolutely does. The definition of non-resident income is, well, it's crucial for anyone with international ties. The bill specifies it includes income that's received or deemed to be received in India, or income that accrues or arises or is deemed to accrue or arise in India.
Okay, that sounds fairly comprehensive.
It is. But here's the fascinating part, and maybe a point of confusion for some. Income that accrues or arises outside India is generally not deemed to accrue or arise in India.
Generally not, unless,
and this is the key, it's derived from a business controlled in India or a profession set up in India.
Okay, so that immediately brings up questions, doesn't it?
Exactly. How does this impact someone, say, working remotely from London for an Indian company, or the other way around?
Is their income sourced in India or outside? Where's the tax liability?
Precisely. This nuanced distinction is vital. It's key for avoiding double taxation or maybe unexpected tax bills for individuals and businesses operating across borders. It needs careful reading.
And the digital age, well, it's certainly thrown some curveballs at traditional tax laws. The bill seems to be playing catch-up here, updating definitions for royalty and fees for technical services in Clause 9. How do these new definitions capture the nuances of our, increasingly digital economy?
You're right. These updates are absolutely essential. Take royalty. The definition now explicitly includes payment for the transfer or the use of computer software. And importantly, it says regardless of the medium on which it's provided.
So downloaded, streamed, cloud-based, doesn't matter.
Doesn't matter. It clarifies that payments for licensing software, streaming content, using cloud services, they're clearly categorized as royalties for tax purposes. And furthermore, computer software itself is defined very broadly. It includes any program on a disk, tape, any other storage device, and listen to this, including customized electronic data.
Customized electronic data, that sounds really broad.
It is a significant expansion. It ensures that income from cutting-edge digital products, bespoke software solutions, maybe even large data sets people sell access to, it all falls squarely within the tax net. It's a very clear signal that the tax framework is adapting, trying to keep pace with technology.
And maybe the most forward-looking, intriguing addition is this explicit definition of virtual digital asset. Clause 1941 hit. This feels like India making a really definitive statement about the future of finance, doesn't it? Especially with crypto and NFTs booming.
This is undoubtedly one of the bill's most significant and, frankly, modernizing provisions, no question. The term transfer, which is defined elsewhere in Clause 2, 109, will now unequivocally apply to any virtual digital asset. And, crucially, it says regardless of whether it's classified as a capital asset or not.
Regardless. So even if it's just held as stock in trade, maybe?
Exactly. This is a monumental step. It brings cryptocurrencies, non-fungible tokens, NFTs, and similar digital assets squarely, unambiguously within the tax net. For a long time, let's be honest, the tax treatment of these assets was murky, kind of a gray area.
Definitely.
So this explicit definition, it reflects global trends in digital asset regulation. It reflects the evolving nature of wealth creation. It basically means whether you're trading Bitcoin, selling an NFT artwork, or doing any transaction with these digital assets, you now have a clear understanding that, yes, these activities are subject to taxation. It effectively closes a loophole and provides much-needed regulatory certainty in this rapidly expanding digital frontier. 2, navigating income heads and key changes.
Okay, so we've covered the foundations, the definitions. Let's move into the specifics of income. Let's talk about capital gains. This is often a source of, well, some head-scratching for many taxpayers. What are the key changes? What's the expanded scope detailed in Chapter 7, Clauses 67 to 91 of this new bill?
Right. Chapter 7, clauses 67 to 91, it gives a pretty comprehensive framework for capital gains. And perhaps the most striking aspect is how significantly the scope of what counts as a transfer has been expanded. It goes way beyond just a simple sale or exchange of an asset.
Okay, so more than just selling something.
Much more. For instance, it now explicitly includes things like relinquishing an asset, just giving up your rights to it, or its compulsory acquisition, say, by the government for a project, or even converting a capital asset, like property, into stock and trade for your business. That conversion itself is now a transfer. This broad definition is clearly designed to ensure that various ways you might realize value from an asset are captured for tax. It tries to prevent attempts to avoid capital gains tax through, let's say, unconventional transactions.
Right. When we think capital gains, yeah, usually stocks or property come to mind first, but you're saying the bill casts a much wider net.
Okay.
And here's where it gets really interesting for me. It even includes transactions that allow someone to, like, enjoy immovable property without actually selling it directly. That's Clause 71.
That's correct. It covers certain arrangements that effectively transfer the benefits of ownership without a formal sale deed.
And this one really caught my eye, Clause 70. It specifically includes converting physical gold into electronic gold receipts, EGRs, and back again.
Yes, that's a very specific and very modern addition, isn't it? Reflecting new financial instruments.
It really is. Shows they're thinking about these newer investment forms.
Exactly. And the bill doesn't stop there. It meticulously details how capital gains are calculated on, say, the distribution of assets when a company goes into liquidation, Clause 68,
Right.
or even when a company buys back its own shares, Clause 69. And crucially, there are comprehensive provisions for complex business reorganizations, things like a partnership firm converting into a company, or transferring shares to a business trust, Clause 71.
Yeah, stuff deal. That sounds vital for startups scaling up or larger companies restructuring.
Absolutely vital. It ensures the tax implications are clear during mergers, acquisitions, spin-offs, all sorts of structural changes. This level of detail aims to remove previous ambiguities that definitely existed in these complex scenarios.
Okay, and what about figuring out the cost of acquisition? That's often a thorny issue, isn't it? Especially with complex financial instruments.
It definitely can be. The bill tries to address this by specifying precise rules for how the cost of acquisition is determined for various assets. It covers quite intricate scenarios, like how do you determine the cost of shares you got when you redeemed Global Depository Receipts, GDRs? That's in Clause 72, table serial number 6.
Wow, specific.
Very specific. Or the cost of units you receive when mutual fund schemes get consolidated. That's also detailed, serial number 8 in the same table. This level of precision, the aim is clearly to eliminate ambiguities that might have existed before. It gives taxpayers and tax officers clear guidelines for calculating the taxable gain, hopefully reducing disputes down the line.
It's good to see some relief provisions in there, too. What about home buyers and industrial relocation? Are there any specific incentives or exemptions under Clauses 82 to 89?
Yes, thankfully there are. The bill includes specific provisions offering capital gains exemptions, particularly when you reinvest the gains into residential houses. And interestingly, under certain conditions outlined in Clause 84.5, you might even be able to purchase or construct 2 residential houses and still claim the exemption.
2 houses. That's quite a significant benefit.
It is, yes, aimed clearly at promoting homeownership. And furthermore, there's an exemption specifically for capital gains that arise when an industrial undertaking shifts from an urban area to a special economic zone, SEZ. That's Clause 87.
Ah, so encouraging businesses to move to SEZs.
Exactly. It's a clear policy signal from the government, isn't it? Incentivizing specific types of development and regional growth by encouraging businesses to relocate to these designated zones.
Okay, let's transition now to what's often the heart of a business's tax calculation, profits and gains of business or profession. That's covered in Clauses 26 to 66. Big picture. What can businesses deduct? And maybe more importantly, what's now disallowed or restricted?
Right. This chapter is absolutely crucial for businesses. Now, the general rule still holds. Expenses incurred wholly and exclusively for the purposes of business or profession are generally allowed as deductions.
Okay, the standard principle.
Yes. But the bill also specifies some important limitations, and this is where businesses need to pay close attention. For instance, take an expense where tax deducted at source, PDS, was required but wasn't actually deducted, or maybe interest, royalty, or fees for technical services, FTS, payable outside India to a non-resident, again, without the proper TDS being done.
What happens then?
Well, under Clause 35B, 30% of that expenditure can be disallowed as a deduction.
30%, that's quite a chunk.
It is. It puts a significant onus on businesses to ensure full compliance with all TDS provisions, especially when dealing with international payments. No room for error there.
And this Clause 36 about excessive payments to related parties. This really caught my attention. Can you give us a quick real-world example? Is this designed to stop, say, a business owner paying their nephew a massively inflated consulting fee just to lower the company's taxable profit?
That's precisely the kind of situation it aims to prevent.
Exactly.
If you make payments to specified persons, and that includes relatives, partners, directors, even companies where you hold a substantial interest on that, and the assessing officer looks at it and deems the payment excessive or unreasonable.
Based on what?
Based on fair market value, the actual needs of the business or the benefit the business actually got from that payment, then that excessive portion, the unreasonable part, will not be allowed as a deduction.
Okay.
It's a critical check. It's designed to prevent tax avoidance through, let's say, artificial transactions between related entities. It ensures deductions are only claimed for legitimate business expenses at market rates.
And what about cash transaction limits? We've seen a massive push towards digital payments in India. Does the bill reinforce that trend?
Oh, it absolutely does, very strongly. Clause 36(5) clearly states that any payment exceeding 10,000 rupees made in a single day to a single person, if it's not done through specified banking channels or online modes like UPI or bank transfer, then that entire payment will be disallowed as a business expense.
10,000 rupees, that's quite a low threshold.
It is. It's slightly higher for payments related to goods carriages, where the limit is 35,000 rupees. But overall, yes, it strongly pushes businesses towards digital transactions. It significantly enhances transparency and traceability in business dealings, and it's clearly aimed at curbing the informal, cash-based economy.
For small and medium enterprises, navigating complex tax rules can be a real nightmare. Does the bill offer any simplification? Maybe through something like presumptive taxation?
Yes, it does. Clause 58 continues and refines the concept of presumptive taxation. This is available for certain specified businesses or professions that have turnovers below certain thresholds. For instance, up to 2 crore turnover for eligible businesses, or 50 lakh gross receipts for eligible professions.
And how does it work?
Instead of maintaining detailed books of accounts and calculating actual profits, which can be burdensome, businesses under this scheme can simply deem their profits to be a certain percentage of their turnover or gross receipts. Generally, it's 8% of turnover. But if the receipts are through digital modes, it's lower at 6%.
Ah, another nudge towards digital.
Exactly. This is a huge simplification for many SMEs. It reduces their compliance burden significantly, making it much easier for them to operate within the tax framework.
And what about specific incentives? For new manufacturing companies, perhaps. Is there a focus on boosting domestic production, aligning with Make in India?
Definitely. Clause 201 offers a very significant incentive for new domestic manufacturing companies, specifically those set up after March 1st, 2016. It allows them to opt for computing their tax at a reduced rate of 25%.
25%. That's lower than the standard corporate rates.
Yes. But there are conditions, of course. The main one is that the company shouldn't be engaged in any business other than manufacturing or production and some ancillary activities. This clearly reflects a policy focus on boosting domestic manufacturing. It aligns perfectly with initiatives like Make in India and aims to encourage fresh investment in the country's industrial base.
Okay, moving on to some other income heads and special regimes. How does the bill tackle income from house property? That's relevant for many people. Clauses 2025, right?
Right. The bill meticulously outlines how the annual value of a house property is determined for tax purposes. That's the base figure. And then it allows for key deductions from that annual value. Firstly, there's a standard deduction, flat 30% of the annual value. No questions asked.
Okay, that's straightforward.
And secondly, crucially for many homeowners who've taken loans, it allows deduction for the interest payable on borrowed capital, as long as that capital was used for acquiring, constructing, repairing, renewing, or reconstructing the property. That's all in Clause 22. This brings much-needed clarity and simplification to the calculations for property owners, making it easier to figure out their tax liability on rental income, or even for self-occupied property in some cases.
Now, this new tax regime for individuals and Hindu undivided families, HUFs, in Clause 202, this feels like a major change that will affect millions. What are the core aspects of this alternative, And what's the big trade-off involved?
This is indeed a seismic shift in individual taxation, a really big deal. The bill introduces this alternative tax regime, completely optional for individuals and HUFs, and it comes with an entirely new set of income tax slab rates.
Lower rates initially, I heard.
Yes, the rates start lower. For instance, income up to 4,000 is nil tax, then 5% up to 8,000, 10% up to 12,000, and so on, eventually reaching 30% for income above 24,000.
Sounds appealing. So what's the catch?
The crucial caveat. As mentioned in Clause 202, if you opt for this new, seemingly simpler regime with lower rates, you have to forego most of the common exemptions and deductions that are available under the old existing regime.
Like what? What kind of deductions are we talking about?
Things like house rent allowance, HRA exemption, leave travel concession, LTA, the standard deduction for salaried employees, most deductions under Chapter VAA like Section 80C for investments like PPF, ELSS, insurance, ADD, health insurance, ADTTA, savings interest, almost all of them go.
Wow. So you trade deductions for lower rates.
Exactly. And that raises a really important question for every single taxpayer. Which regime is actually more beneficial for you? For some people, maybe those with fewer investments or claims, the simplicity and lower rates of the new regime might be better. But for others, especially those who actively use deductions for HRA, home loans, investments under ADC, etc., the old regime might still result in lower overall tax.
So it's not a one-size-fits-all answer.
Not at all. It truly becomes a personal calculation. You have to run the numbers based on your specific income, investments, and expenses.
And then there are these highly specialized regimes, like the tonnage tax scheme for shipping companies, clauses 225, 234. Who does this benefit and sort of how does it work?
Right. This is a very specific scheme tailored for India's shipping industry. It allows qualifying shipping companies to choose to compute their income based on the net tonnage, essentially, the carrying capacity of their ships, instead of calculating profits based on traditional accounting, which can be very volatile in the shipping business.
So it gives them more predictability.
Exactly. It offers a predictable and stable tax environment, which is meant to encourage investment in the sector. The bill also includes clear rules for opting into the scheme, opting out, and importantly, anti-abuse rules, like in Clause 2341, to prevent companies from misusing it. It's a very targeted incentive designed to enhance the competitiveness of India's maritime sector on the global stage. 3. Deductions, exemptions, and reliefs. What you can save.
Okay, let's pivot now to maybe the more welcome news for taxpayers. Deductions, exemptions, reliefs, basically all the ways you might be able to save some money on your taxes. Starting with personal deductions, Chapter 8, Part B. What's the big picture in Section 123? Is it similar to the old Section 80C?
Yes, Section 123 functions very similarly to the well-known Section 80C under the old Act. It consolidates various popular deductions for individuals and Hindu undivided families, HUFs, under one single clause, and it maintains that familiar aggregate cap of $1,050,000.
So still 1.5 lakh, okay.
Yes, and this covers a range of common investments and expenses like life insurance premiums, contributions to provident funds like EPF or PPF, tuition fees for children, principal repayment on housing loans, investments in specific schemes like NSC or ELSS, and deferred annuities. It remains a familiar and widely used relief, clearly designed to encourage long-term savings and provide a foundational level of tax benefit for many salaried individuals and families.
And what about health and medical expenses? That's covered in Clause 126, right?
Right.
This feels like a very practical provision for everyday life.
Absolutely. Health is a major focus. For health insurance premiums paid, and also for preventive health checkups, individuals can claim a deduction. The limit is generally up to $25,500 for yourself, your spouse, and dependent children, and there's a separate limit of up to $25,000 for parents, or $50,000 if the parents are senior citizens.
And the $50,000 limit also applies if the taxpayer themselves is a senior citizen.
That's right. If the individual paying the premium is a senior citizen, their limit is also $50,000. What's particularly practical here, as specified in Clause 126.3, is that payments made in cash, specifically for preventive health checkups up to $5,000 within the overall limit, are also allowed as a deduction.
Oh, that's useful, because those checkups are sometimes paid in cash.
Exactly. This provision highlights a direct focus on public health, encouraging citizens to prioritize their well-being and get preventive care, while also acknowledging the practical reality of how these small payments are often made.
Supporting dependents with disabilities is obviously a crucial social provision. How does Clause 127 address this?
This is indeed a vital social measure. Clause 127 allows deductions for expenses incurred on the medical treatment, including nursing, training, or rehabilitation of a dependent who is a person with a disability or a severe disability. The bill specifies fixed deduction amounts, irrespective of the actual expenditure.
Amounts.
Yes. It's $75,000 per year if the dependent has a disability, and $1,025,000 per year if the dependent has a severe disability, as defined under the relevant laws. This provides essential, predictable financial support for families caring for disabled dependents, recognizing the significant additional costs involved and offering a degree of relief for their dedicated care.
And for those investing in their future, or maybe their children's future, how does the bill treat the interest paid on higher education loans? That's Clause 129.
Yes. Clause 129 provides a significant incentive for investing in human capital, in education. You can claim a deduction for the interest paid on a loan taken for higher education. And importantly, higher education explicitly includes vocational courses as well, not just traditional degrees.
Who can the loan be for?
The loan can be taken for yourself, your spouse, your children, or even for a student for whom you are the legal guardian. That's covered in Clause 129 too. This deduction is available for up to 8 years, starting from the year you begin paying interest. It really helps make education more accessible by reducing the financial burden of student loans, thereby promoting skill development and, ultimately, economic mobility.
Philanthropy is also encouraged, right? What are the provisions for donations to good causes in Clause 132? Is it similar to Section 80G?
Very similar to the old Section 80G, yes. The bill continues to allow deductions for donations made to various specified funds and institutions. This includes well-known ones like the National Defense Fund, the Prime Minister's National Relief Fund, approved universities and educational institutions of national eminence, and various other registered charitable institutions. Some donations get 100% deduction, others 50%, sometimes with a qualifying limit based on income.
Okay, the structure sounds familiar. Any changes?
One interesting detail, echoing the push against cash. Cash donations exceeding €1 will not be allowed as a deduction under Clause 132B.
Only 2,000 rupees.
Yes. Any donation above that amount must be made through banking channels or digital modes to qualify for the deduction. This specific limit reinforces that broader push for digital transactions and transparency in financial dealings, even when it comes to charitable giving.
Okay, let's shift gears slightly to business and corporate deductions now. Under Chapter 8, Part C, Clause 146 offers a deduction for additional employee cost. That sounds like a very direct incentive for job creation. How does it work?
It absolutely is designed for that. To incentivize employment, businesses can claim an additional deduction for the additional employee cost incurred when they hire new employees. This applies to new employees joining after April 1st, 2017, who meet certain criteria regarding salary and Provident Fund participation. And this deduction, which is 30% of the additional employee cost, can be claimed for a period of 3 assessment years, as mentioned in Clause 146, too. This is quite significant. Sorry, I should double-check the duration outline. It says 5 years. Let me assume 3 years for now based on common existing provisions, unless the bill text explicitly says 5. Let's stick with the outline's 5 years. Yes, Clause 146.2 suggests a period of 5 tax years.
5 years. Okay, that's a decent window.
It is. This provision is directly aimed at encouraging businesses, particularly in certain sectors maybe, to expand their workforce and contribute meaningfully to job creation, aligning with the government's broader economic goals of tackling unemployment.
And are there continued deductions for businesses operating in specific zones like SEZs or those engaged in strategic activities?
Yes, absolutely. The bill continues to provide significant tax benefits for businesses operating within special economic zones, SEZs, under Clause 144, although these benefits are often phased out over time, according to the SEZ Act provisions. It also extends deductions or benefits to businesses engaged in specific, often socially or environmentally desirable activities. For example, collecting and processing biodegradable waste, Clause 145, running agricultural extension projects, Clause 47, or even for capital expenditure on setting up specified facilities like semiconductor fabrication or electronics manufacturing units, as indicated in Clause 612, and its associated table, SECL number 6.
So targeted incentives.
Exactly. These provisions clearly highlight the strategic sectors and activities that the government is actively promoting through the tax system, trying to channel investment and effort into areas deemed critical for economic growth, sustainability, or technological advancement.
Now let's talk about exempt incomes, the money you earn that simply isn't part of your taxable income at all. What falls into this category under Chapter 4 and Schedule of 4? Starting with the big one, agricultural income.
Right.
Agricultural income remains entirely exempt from central income tax, as specified in Schedule 3, Clause 245. This is a long-standing policy reflecting India's large agrarian economy and aiming to support its vast farming sector. However, the bill is careful to specifically define what constitutes agricultural income.
How's it defined?
It's defined as rent or revenue derived from land situated in India and used for agricultural purposes, or income derived directly from carrying out agricultural operations on such land, including processing produce to make it marketable or selling such produce. Income from farm buildings is also included under conditions. This precise definition ensures the exemption is strictly applied to genuine agricultural activities and isn't misused for other types of income disguised as agricultural.
And what about political parties and electoral trusts? Their income is also generally exempt under Clause 12, correct? That's right. The income of registered political parties and approved electoral trusts is generally exempt from income tax. This exemption covers income from sources like house property, voluntary contributions received, capital gains, and income from other sources.
But there are conditions, I assume.
Oh, yes, absolutely. Crucial conditions aimed at ensuring transparency and accountability. These organizations must maintain proper books of account, keep records of contributions, especially those above 20,000, including donor details, and get their accounts audited annually. That's laid out in Clause 12.1. Failure to comply with these conditions can lead to the loss of exemption. This provision is designed to bring greater scrutiny and regulation to political funding.
There are also specific exemptions mentioned for scheduled tribes and Sikkim subjects in Schedule 3. What are the nuances here? These seem very specific.
They are, and they address important regional and social considerations, often rooted in historical contexts. Income earned by a member of a scheduled tribe residing in certain specified tribal areas, mostly in the northeastern states like Arunachal Pradesh, Manipur, Mizoram, Nagaland, Tripura, plus some areas in Assam and Meghalaya is exempt.
What kind of income?
Income from any source within those specified areas, or income from dividends and interest on securities wherever earned. That's in Schedule 3, Table Sessel Number 1. Similarly, there are exemptions for individuals defined as Sikkim subjects based on the Sikkim Citizenship Order 1975. Even those not originally domiciled there but meeting certain familial criteria, as detailed in Schedule 3, Table Cello Number 35-4, can benefit from exemptions on certain incomes. These exemptions are designed to provide economic support and respect the unique social, historical, and constitutional statuses of these specific communities.
And this next one sounds like a very targeted incentive aimed at bringing in big money from overseas. The exemption for sovereign wealth funds and pension funds in Schedule V.
Why is this considered so significant? This is indeed a critical provision, strategically designed to attract large-scale, long-term foreign investment into India, particularly for infrastructure and other key sectors needing patient capital. It provides an exemption for income like dividends, interest, and long-term capital gains accruing to or received by specified sovereign wealth funds, SWFs, or pension funds.
What qualifies them?
There are strict criteria. They must be established outside India, operate primarily on a not-for-profit basis, be owned wholly or substantially by a foreign government, and importantly, be exempt from taxation in their home country. They also need to invest in specified infrastructure sectors or other notified businesses in India.
So very specific entities.
Very specific, yes. This is a highly targeted incentive. It's designed to draw in these massive pools of global capital, which often seek stable, long-term returns and funnel that money directly into critical development projects within India. It clearly signals the government's focus on boosting infrastructure and attracting strategic foreign investments. 4. Compliance, enforcement, and penalties. The rules of the game.
Okay, let's shift now to the rules of the game, as you called it earlier. Compliance, enforcement, penalties. This is where the government ensures everyone, well, plays by the book. First up, streamlining procedures. The bill talks about moving towards a faceless future in Chapter 16, Clause 273. For the listener, what does faceless assessment actually mean for their interaction with the tax department? Does it mean less running around, fewer chances of, let's just say, misunderstandings with an officer face-to-face?
That's precisely the aim. Faceless assessment and related schemes like faceless appeals, faceless penalty proceedings. It's a significant philosophical shift. It aims to eliminate the physical interface, the direct contact between the income tax authority and the SSC during these processes.
How does it work in practice?
Assessments, appeals, penalties are conducted entirely electronically. Cases are assigned randomly to officers across the country using algorithms. Notices are issued electronically, responses are filed online, and orders are passed digitally. For you, the taxpayer, it ideally means the process becomes more objective, more standardized, potentially faster, and significantly reduces opportunities for corruption or undue influence.
So more efficient and transparent.
That's the goal. Fostering a more trust-based, albeit more digital and distant, system of tax administration. It's a fundamental change.
And there's also mention of a dispute resolution panel in Clause 275. Is this a completely new layer to potentially reduce litigation, or is it just another administrative step?
It's not entirely new. It builds on an existing concept, but it's formalized here for eligible assessees, typically involving foreign companies or transfer pricing issues. If the assessing officer proposes a variation to the income returned, which is prejudicial to the assessee's interest, they first have to issue a draft order. The assessee then has the option to either accept it or file objections with the Dispute Resolution Panel, DRP.
And what does the DRP do?
The DRP, which consists of senior tax officials, examines the case and issues directions. Crucially, these directions are binding on the assessing officer. So it provides an important layer of review and potential dispute resolution before a final assessment order is passed and formal appeals begin.
So the intent is to reduce litigation.
The intent is certainly to reduce litigation by resolving disputes, especially complex international tax ones, at an earlier stage through this specialized panel. Whether it achieves a significant reduction in the long run, well, that depends on its practical functioning and effectiveness.
The permanent account number, PAN, and Aadhaar. They become absolutely indispensable for financial transactions in India, haven't they? Does the new bill strengthen their role? I think you mentioned Chapter 55, Clause 262 earlier.
Absolutely. Their importance is further cemented. The bill explicitly reiterates that if you already have a PAN, you cannot apply for another one. One person, one PAN.
Okay, clear enough.
Furthermore, it mandates, under Clause 262, that every person entering into certain prescribed high-value transactions must quote their PAN or their Aadhaar number. The list of prescribed transactions is quite extensive, things like bank deposits over a limit, property transactions, vehicle purchases, share trading, foreign travel payments, hotel bills above a certain amount, even financial transactions aggregating to $2,050,000 TNA in a tax year.
So pretty much any significant financial activity.
Pretty much. This reinforces the critical role of PAN and Aadhaar as unique identifiers for financial traceability and accountability. It makes it much harder for undeclared wealth or large transactions to escape the system's notice.
Now let's talk about tax deduction and collection at source TDS and TCS. That's in Chapter 19, Clauses 390-403. This is how a huge chunk of tax is collected up front, right?
Indeed. TDS and TCS are foundational pillars of India's tax collection system. They ensure tax is collected efficiently at the very point where income is generated or a specific transaction occurs. The bill continues and refines the extensive provisions for TDS and TCS across a wide array of income types and payments. Familiar areas like TDS on salaries, Clause 392, interest income, dividends, rent, Clause 393(1), table, SL number 2, commissions, professional fees, payments to contractors. It's all detailed there. The idea remains the same. Collect tax at source, make compliance easier for the recipient later, and reduce opportunities for evasion.
Okay, but here's where it gets really interesting, especially for the digital economy. The introduction of TDS on virtual digital assets. That's in Clause 393. Table says L underway, you said. What does a 1% TDS mean in practice for people trading cryptocurrencies or NFTs?
This is a very significant move, a direct response to the burgeoning crypto economy. The bill mandates a 1% TDS on the payment made for the transfer of a virtual digital asset, VDA.
So when I sell crypto on an exchange, they deduct 1%.
Essentially, yes. The responsibility falls on the person paying the consideration, typically the buyer, or the exchange facilitating the transaction. They must deduct 1% of the transaction value, above certain thresholds, before making the payment to the seller. This 1% TDS applies regardless of whether the VDA is a capital asset or not for the seller.
What's the purpose of such a low rate, 1%?
It's primarily for tracking. The main goal isn't revenue collection through the TDS itself, but rather to create a transaction trail. It ensures that these transactions are reported to the tax department, bringing visibility to the VDA ecosystem. It's a clear move to capture these transactions within the tax net right at the point of sale or transfer. It's a game changer for the virtual asset space in India, bringing it firmly into the reporting framework.
And what are the consequences if someone fails to comply with these TDS-TCS rules? It sounds like the bill's pretty strict on this.
It definitely is. The responsibilities of the deductor or collector are taken very seriously. failure to deduct or collect tax at source when required, or, equally important, failure to deposit the collected tax with the government within the stipulated time. Both attract significant consequences. There's interest payable on the amount not deducted, collected, or deposited late, as per Clause 398. And there can also be penalties levied, potentially equal to the amount of tax that wasn't deducted or paid. In some cases of willful failure, prosecution is also possible. So yes, the bill reinforces stringent compliance requirements. Any lapse will have clear financial and potentially legal ramifications.
Finally, let's look at the sharper end. Offenses and penalties in Chapter 22. What happens when things go genuinely wrong, or when someone deliberately tries to evade tax? There are provisions for underreported income, right? Clause 439.
Yes, the bill lays out clear and substantial penalties specifically for underreported income. If income is found to be underreported due to reasons other than misreporting, the penalty is 50% of the tax payable on that underreported income.
Okay, 50%. But what if it's considered misreporting?
If the underreporting is deemed to be due to misreporting of income, and the bill lists specific instances that qualify as misreporting, the penalty jumps significantly.
What counts as misreporting?
Things like misrepresentation or suppression of facts, failure to accord investments in the books, claiming expenses not substantiated by evidence, recording false entries, or failing to report international transactions or specified domestic transactions. That's detailed in Clause 439.11.
And the penalty then is?
In cases of misreporting, the penalty is a hefty 200% of the tax payable on the misreported income.
200%. That's a very strong deterrent.
It is. It's clearly designed as a strong deterrent against deliberate tax evasion and dishonest reporting, signaling a zero-tolerance approach from the government.
And what about outright false statements or, say, falsification of documents?
Yeah.
What are the legal ramifications for something like that under Clauses 482 and 483? Are we talking jail time?
Yes, we are. The bill treats these very seriously. Providing a statement in any verification or delivering an account or statement which is false and which the person either knows or believes to be false or does not believe to be true, Clause 482, or deliberately falsifying books of account or other documents with the intent to evade tax, Clause 483. Both can lead to severe consequences upon prosecution and conviction. This includes rigorous imprisonment, which can extend up to 7 years in some cases, along with substantial fines.
So criminal charges.
Absolutely. This underscores the serious legal ramifications of financial misrepresentation within the tax system. The bill is unambiguous about ensuring the integrity of financial records and statements. Deliberately misleading tax authorities is treated as a serious criminal offense.
Interestingly, though, the bill also provides for a reasonable cause defense in Clause 486. Does this offer some measure of flexibility or fairness?
Yes, and this is an important aspect of fairness in the system. Clause 486 explicitly states that no person shall be punishable for certain failures under the penalty or prosecution provisions. For example, failing to deduct or collect tax at source, or failing to furnish returns or statements on time, if they can prove there was a reasonable cause for such failure.
What counts as reasonable cause isn't defined, though, I guess.
No, that's usually left to the interpretation of the authorities and courts based on the facts of each case. But the provision itself offers a degree of flexibility. It recognizes that genuine errors, unforeseen circumstances, or situations beyond one's control can occur. It prevents the automatic imposition of harsh penalties or prosecution for minor, unintentional lapses where a genuine reason exists, allowing for a more equitable application of the law.
And just quickly, there were also specific provisions mentioned regarding strategic disinvestment in public sector companies in Clause 116.4. What does this mean in the context of government privatization efforts?
Right. The bill carefully addresses the tax implications when a public sector company undergoes strategic disinvestment, meaning a government sells a controlling stake. It provides specific rules for how accumulated business losses and unabsorbed depreciation of that company can be carried forward and set off after the disinvestment. Usually, there are restrictions on carry forward when ownership changes significantly, but special provisions apply here.
So it facilitates a process.
It facilitates the process by providing clarity on the tax treatment of past losses. However, crucially, it also includes a clawback provision. If certain conditions, often related to continuing the business or employment, aren't met within a specified period after the disinvestment, the tax benefits initially allowed regarding the losses can be reversed or withdrawn.
So benefits with strings attached.
Exactly. This reflects the government's nuanced approach to privatization. It aims to make the process smoother while also ensuring that the tax benefits granted are aligned with long-term policy objectives, like ensuring the privatized entity continues to operate effectively and includes safeguards against misuse or non-fulfillment of the disinvestment goals, v. special cases and miscellaneous provisions.
Okay, as we start to wrap up this deep dive, let's touch upon some special cases and miscellaneous provisions that kind of round out the bill. First, the taxation of unexplained assets and income. That's clauses 102 to 106. This sounds like a pretty powerful tool against undeclared wealth or black money.
It absolutely is. These provisions are a cornerstone of the measures against unaccounted wealth. The bill clearly specifies that if any credits are found in the books of account, Clause 102, or any investments are made, Clause 103, or any money, bullion, jewelry, or other valuable article is found, Clause 104, or any expenditure is incurred, Clause 105. And the SSC offers no explanation about the source or nature, or the explanation offered is unsatisfactory in the opinion of the assessing officer.
Then what happens?
Then the value of such credits, investments, assets, or expenditures will be deemed to be the income of the assessee for that tax year. And importantly, tax on such deemed income is usually levied at a much higher flat rate, often around 60% plus surcharge and cess, with no deductions allowed.
Wow. So a very strong disincentive.
Extremely strong. It's a very powerful tool in the government's arsenal against black money and illicit financial activities, ensuring that any wealth or spending that appears without a legitimate, explainable source can be brought into the tax net and taxed punitively.
And what about cash loans and repayments, specifically Clause 106? How does this impact, say, informal lending networks that still exist?
Clause 106 is also aimed squarely at curbing cash transactions, particularly in lending. It deems any amount, including interest, that is borrowed or repaid using a negotiable instrument like a hundi, a traditional informal bill of exchange, or any amount borrowed or repaid in relation to a loan or deposit other than through an account paycheck, account pay bank draft, or specified electronic modes like bank transfer, UPI, will be deemed as income of the person borrowing or repaying for that tax year, again, likely taxed at the higher punitive rates.
So basically, large loans or repayments in cash are heavily penalized.
Heavily penalized, yes. It strongly discourages large cash transactions in lending and repayment, aiming to force these activities into formal, traceable banking channels. And it definitely raises an important question. What impact will this have on the long-standing informal lending networks that are still prevalent in various parts of India? Will it push them towards formalization or drive them further underground? That remains to be seen.
Okay, moving on to registered nonprofit organizations, NPOs. Chapter 8 Share, clauses 332-353. This sounds like a significant update for charities, trusts, and other similar organizations.
It is indeed. The bill introduces a new, much more detailed and consolidated framework for the registration, regulation, and taxation of nonprofit organizations. This covers public charitable or religious trusts, societies registered under the Societies Registration Act, and Section 8 companies, companies formed for charitable objects. Key changes include a requirement for all existing NPOs to reapply for registration under the new regime to continue claiming tax exemption. They are also required to maintain specific books of account as per Clause 346 and mandatorily get their accounts audited annually as per Clause 347.
So increased compliance and scrutiny.
Definitely. It's designed to bring a much higher degree of transparency, accountability, and uniformity to the sector, ensuring public trust in organizations that enjoy significant tax benefits.
And this next point really caught my eye. Restrictions on commercial activities for these nonprofits. So, if I run a small charity, maybe we sell some merchandise online to raise funds. How does this 20% rule impact that? Is it government trying to draw a clearer line between genuine charities and maybe those using their status for commercial gain?
That's a great practical question, and yes, that's precisely the intent behind this provision. The bill stipulates that if a registered nonprofit engages in any business activities, even if the income is applied towards its charitable objectives, it must maintain separate books of account specifically for those business activities. That's Clause 346C.
Separate books, okay.
And more importantly, the aggregate receipts from all such incidental business activities in a given tax year should not exceed 20% of the total receipts of the nonprofit for that year. That's the threshold in Clause 345, too.
20%. What if they cross that limit?
If the receipts from business activities exceed 20% of total receipts, the NPO could potentially lose its tax exemption for that year, or at least face tax on the excess business income, depending on the specifics. So yes, it's a critical provision. It aims to ensure that the primary purpose and activity of the organization remain genuinely charitable or religious, and that they don't effectively morph into commercial enterprises just leveraging their tax-exempt status. It draws a much clearer line between incidental fundraising and substantial commercial operations.
And what happens if a nonprofit violates these new rules or other key conditions? Are there specified violations listed that can lead to cancellation of the registration? That's Clause 349.
Yes, the bill explicitly lists several specified violations that can trigger proceedings for the cancellation of an NPO's registration and tax exemption. These violations include things like applying its income for non-charitable or non-religious purposes, benefiting specific persons like trustees or founders inappropriately, diverting income, or failing to comply with other laws relevant to achieving its objectives. Also, not investing accumulated income as prescribed under the Act, or violating the conditions related to registration or auditing can be grounds.
So stricter enforcement.
Definitely stricter enforcement and clearer grounds for action. It significantly increases the accountability and oversight for organizations benefiting from tax-exempt status, ensuring they adhere strictly to their stated charitable objectives and comply fully with the regulations governing their finances and operations. It's all about maintaining the integrity of the nonprofit sector.
The bill also includes provisions for advance rulings and appeals, Chapters 8 and 710. For foreign investors, getting certainty on their potential tax liability before they invest huge amounts is absolutely crucial, isn't it? How do advance rulings help here?
They are incredibly helpful for providing tax certainty, especially for non-residents and certain specified residents engaging in complex transactions. The Board for Advance Rulings, BAR, is empowered to provide binding determinations on questions of law or fact regarding the tax liability arising out of transactions that have been undertaken or are proposed to be undertaken by the applicant. That's Clause 380A.
Binding. On whom?
What's key here is that these rulings, once pronounced, are binding on both the applicant who sought the ruling and on the income tax authorities concerning that specific transaction. That's per Clause 386. This offers immense certainty. It allows foreign investors, for instance, to understand their tax position definitively upfront before committing significant capital, thereby de-risking their investment and facilitating smoother cross-border business into India.
And what about the general appeals process for everyone else? Does the bill ensure a robust mechanism for taxpayers to challenge assessments they disagree with, including going up to the High Court and Supreme Court?
It does. The bill retains and refines the established, structured, multi-tiered appellate process. If a taxpayer is aggrieved by an order, say, an assessment order from the assessing officer, they can first appeal to the Commissioner Appeals. If they're not satisfied with the Commissioner Appeals decision, they can then appeal to the Income Tax Appellate Tribunal, ITAT, which is the final fact-finding authority. And beyond the ITAT, appeals can be made to the High Court, but generally only on substantial questions of law arising from the tribunal's order. And finally, in certain cases, appeals can go all the way to the Supreme Court. This entire structure is detailed across clauses 361 to 368.
So multiple levels of review.
Yes. This tiered system ensures multiple opportunities for review, providing taxpayers with a comprehensive and robust mechanism for challenging assessments and ensuring their fundamental right to a fair hearing and due process is protected.
Finally, let's just touch on the bigger picture again. The bill's emphasis on facilitating electronic modes of payment. We saw this with deductions, TDS, and PO donations. It seems to be a recurring theme, right? Clauses 64 and 187 were mentioned.
It's absolutely a recurring theme and a clear policy direction woven throughout the bill. It strongly aligns with India's broader push towards a digital economy, Digital India. The bill not only includes provisions that encourage or incentivize electronic payments, like the lower presumptive tax rate for digital receipts. Clause 64 relates more broadly to computation methods, but it also goes further in some areas. Clause 187, for instance, mandates that certain businesses, those with turnover exceeding a specific limit, must provide facilities for accepting payments through prescribed electronic modes in addition to other payment options they might offer. Failure to do so can attract penalties.
So it's not just encouraged, it's mandated for some.
Exactly. This is more than just about convenience. It's a strategic move aimed at enhancing transparency in transactions, reducing the circulation of unaccounted cash, improving tax compliance, and bringing more of the economy into the formal, traceable digital realm. It's another significant step towards building a more digitized, efficient, and transparent financial ecosystem for the country. Outro.
So, wow. We've journeyed through a lot today, haven't we? We've unpacked this proposed new income tax bill, 2025. From its fundamental definitions, exploring the detailed provisions on capital gains, business profits, those personal deductions we all look for, and even diving into the really new stuff, like the rules for virtual digital assets and the changes for nonprofit organizations. It's clear this isn't just some dry legal document tucked away somewhere. It's truly a blueprint, isn't it? A blueprint for India's economic and financial future, really aiming for clarity, efficiency, and a serious modernization of its tax system.
Absolutely. And as we've seen, this bill isn't merely about collecting revenue, though of course that's a primary function. It clearly reflects strategic governmental priorities. We've discussed how it aims to promote manufacturing, incentivize employment, drive digital transactions, seeks to attract that crucial foreign investment, and enhance accountability for nonprofits. The meticulous, sometimes almost granular detailing of each clause really highlights a comprehensive and deliberate approach, an attempt to modernize the entire tax framework, adapting it to the demands of today's rapidly evolving global and digital economy.
And as we move towards this potential new era of taxation, assuming this bill becomes law, the details we've discussed today, they're going to directly impact how you, listening right now, manage your finances. Whether you're an individual figuring out your salary and investments, a business owner planning your expenses and deductions, or involved with a nonprofit trying to ensure compliance. Understanding these shifts is absolutely key to being well-informed and prepared for what's coming.
And maybe a final thought to leave with our listeners. If the overarching aim of this new bill is indeed, as stated, to make the Tax Act lucid and easy to read, what does this imply for the future of tax literacy in India? Could we see a shift? And perhaps more provocatively, how might a genuinely simpler, clearer tax code, if that's what this achieves, empower more citizens? Empower them to actively engage with their financial responsibilities, maybe even understand the system better, rather than just, passively complying? Could it foster a greater sense of ownership over their economic contributions?
That is a provocative thought indeed, something for all of us to mull over. And that's all the time we have for this deep dive into India's proposed Income Tax Bill 2025. Thank you so much for joining us today. We really hope this exploration has given you the essential nuggets of knowledge, the core insights to feel truly well informed about this major potential change. Until next time, keep digging deeper.